Good morning. Good morning, everyone. Welcome back to the webinar. Welcome to 2023. We're going to be making some forecasts for what the year may have ahead of us. I've got some branding. I've gone digital. So that's exciting for the new year. But before we get into 2023, which is going to be just as crazy, I suspect, as 2022, let's review very quickly what happened in 2022, just for a couple of slides, because it was a shocker. It was a dreadful year for investors. And you can see that kind of on this chart. Unless you're in energy, which promptly went up 60% as a sector, you were pretty well toasted for the year. The S&P was down about 20%. You can see real estate was down 25% at the bottom of the page. And then a whole cluster of information technology, consumer discretionary and communication. That's because a bunch of the FANG stocks like Tesla, Netflix, etc., actually live outside the IT sector. So that was down around about 30-40%, and the Nasdaq itself was down 30%. So equities, no real place to hide apart from energy, thanks to the dreadful war in Ukraine, which pushed up oil prices, more commodity prices. As everyone realized that Russia actually produced quite a lot of commodities. We'll come back onto that. So pretty tough year, and it was a tough year for pretty much everything. Pretty much everything went down. This shows you the, whoops, a daisy. Sorry, I'll get on the slides here. This shows you equities down in blue, which is the FTSE All World, and then bonds in red. So very unusually, equities and bonds went down together. We kind of own 60-40 portfolio, 60 equities, 40 bonds, because bonds are meant to diversify. They go up when equities go down. Didn't happen last year. Very, very rare event that doesn't happen. I'll show you how rare that event is. In a second, I seem to be losing control of my thing here. There we go. Forgive me, I'm on a new machine. Okay, Annus Horribilis, last coined by our late Queen Elizabeth. About the Lady Diana death year, but that's by the by. It was a terrible year, horrible year. This shows you the red dot is 2022. US stocks were down, as I said, 15-20%. And on the horizontal axis is what US bonds did. So again, they were down about 15-20%. So mostly you're on the kind of top right quadrant of this slide, which is stocks are up, bonds are up. That tends to be what happens. Or if stocks are down, bonds are up, which is the top left quadrant. This was a bottom left quadrant, stocks and bonds down. And that last happened in 1941, 1969, 1987, just about, but nowhere near as badly as 2022 was. So notable as a standout awful year. 2023, before we get on to our forecasting, we're off to a great start in 2023. This shows you actually European equities, which had a particularly good start. First 5 trading days, they were up 5 percentage points, which is a very, very strong start to any year. So the question is this just a bear market rally, or is it the start of something new? And we're back off to the races again. Well, let's tell you what I think. Forecast for 2023. Okay. Left-hand column is what I think the asset classes will do over the course of this year. And then you can see today's level and then what I think end 2023 will be. So S&P 500 at the top, global equities. S&P 500 is a proxy for global equities. Today, S&P is about 4,000. I think it'll end this year at 3,400. So down 15%. So another bad year. Sorry, that's the headline. We'll come on to why in a second. By the way, before I get into these, we rarely give these kinds of forecasts, and these are my forecasts. They do reflect at Old Mutual Investment Group what we think broadly is going to happen. But I wouldn't want to be, the firm to be held to these, or let me held to them, because we rarely give these kinds of things out. But I thought it'd be instructive to see what certainly I'm really thinking. And the other disclaimer before we get into it is we manage all these asset allocation things behind the scenes. So for clients and advisors, stick with your balanced fund. I always say it, which is a mix of all these things. Stick with that, and we'll do the stuff behind the scenes. If you want to do a little bit on the side in gold or something, that's fine. But the core of the portfolio should always be a nicely balanced portfolio, and we'll do this the movements at the back end. But anyway, in terms of the headlines, equities and bonds down, real estate also down. I'm particularly concerned about. Commodities, on the other hand, will have another good year, up 15%, along with gold. I'll come back onto the reasoning for all these things just in a moment. Bitcoin, here we go, up 30%. Bitcoin's up 30% in the last month. I think it'll keep on going up. I'll again come back onto the reasons. Hope springs eternal in that area. I think it'll be a relatively good year for South Africa, a strong rand, and an okay equity market in an environment where equity markets are generally weak. Okay, those are the headlines. You can log off now if you want to. Here's the reasoning behind them. Okay, equities first of all. Let's remind ourselves of what has pushed equity markets for the last decade. And I've talked about this a lot, and we did say that equity markets would be weak last year, and they were weak, and bond markets were also weak, which we said. So we're on a slight roll, not an overall roll. We get certainly lots of things wrong as well. But we said that there was too much money around, and at some point that was going to lead to inflation, and rates would have to go up. So this is a reminder of that. You can see, give or take, $25–30 trillion of stimulus into the world economy. World GDP is about $100 trillion, so that's about 30% of gross domestic product hitting the markets. So massive amounts of cash. And that cash found its way into equity markets. As a reminder, the central bank buys bonds off JP Morgan or Goldman Sachs, wherever they are. They get cash in return for the bonds, and Goldman Sachs or JP Morgan recycle them into either lending out or more likely back into other asset classes. And more risky asset classes as yields came down. So that kind of cycling effect of Fed money printing in response to COVID and slowdowns into particularly asset classes, not really the real economy. We've had extreme asset price inflation because of money printing over the last decade. That is a big problem. So what the Fed thought it was doing was money printing to support the real economy, had a bit of an effect, but what it really had a big effect on was asset price inflation. So everything went up. Equities, bonds, art, classic cars, wine, you name it, everything went up. And now it's starting to deflate. That's really the message. And it's starting to deflate because it has found its way finally into inflation, which we all suffer from as prices go up. So on the left-hand side of this chart, you can see annual change in CPI. This goes back to 1979, which is the last big spike in inflation. And inflation spiked in north of 10%. It's starting to come down, but I think it's going to get sticky shortly. But in response to higher inflation, finally, the Federal Reserve and the UK and others, and the ECB, have increased interest rates. So rates have gone up to, give or take, 3–4%, that kind of range. Markets expecting to peak around about just above this level. And that is sucking liquidity out of the system. And this takes a little time to unfold, which is why I think actually we're in a bear market rally. The market remains really sanguine about central banks' ability to get inflation back to 2%. And it just seems to be a nice, smooth, obedient inflation thing. This shows you what the market is implying for inflation. And you can see as we went through last year into this year, or last year, previous and last year, inflation expectations went kind of up and up and up as inflation went up, but still always expecting inflation to come back to 2%. I think that's far too sanguine. People have an enormous amount of faith in central banks. For those of us who have some recollection of the 1970s, we'll recall that it's not so simple to tame inflation that way. So the market's expecting inflation sorted pretty quickly, back to 2%, happy days, and interest rates come down. This chart shows you in green what the market expects interest rates in America to do, okay, over the next year. In red or purple is what the Fed said it's going to do, give or take. It never says exactly, but they're pretty clear. And the Fed has said rates are going to go from whatever they are now, 4.25%, 4.5%, to above 5%, and will stay there for quite a long time until inflation comes down. stay above 5%. So the market expects rates to peak below 5% to come down to 4.5% by the end of this year, and then come down to 3% by the end of the following year. So it's a big dislocation between what the Fed said they're going to do with rates and what the market thinks rates are going to do. And that's because the market expects inflation to be tamed fairly quickly. I think that's unlikely, and I think rates will stay higher for longer than the market thinks. And this is having an effect, of course, on real activity in the economy. As rates go up, the affordability of housing goes down, and the pressure on the housing market, particularly where a lot of the debt sits, becomes a little acute. And we're starting to see strains in the economy coming through now. Not everywhere, because unemployment is still very low, which is part of the reason the Fed has to do more and more to slow this thing down. But in the housing sector, which is why I'm bearish on real estate, going back to that forecast, down 10% over the year, this shows you the movement in family home sales, sales volume from the moment of the first Fed hike back to 1977. So rates go up, housing sales go down. And you can see this is the fastest slowdown on record. This would be the United States. So sales are collapsing and prices are starting to come down. And you can see that in the UK, where house prices have contracted now for the fourth consecutive month. So you're seeing that price pressure in the housing market. Okay. So real estate under pressure and likely to come down further. Don't be long on property. And as the economy slows down, of course, corporate profits come under pressure. But the market is still expecting corporate profits to be up in 2023 by give or take 3 to 5% positive. Okay. Having gone up by around 25% since the start of COVID. So corporate profits have done very well through the COVID period. The market expects them to go up again this year by around 5%. In a normal stroke mild recession, which is what certainly I expect, and at Old Mutual we expect some pressure in terms of a recession. In a normal recession, profits fall by around 20%. This chart shows you, by sector. The kind of bar charts are the average during the past 3 recessions. So that's what I'm talking about in terms of the average fall in profits. And the red dot is the change this time from the most recent peak. Okay. So let's take financials. Good example, kind of midway through. Usually in a recession, financial profits fall by 35%. Currently they're flat, and the market expects them to keep on going up. I just think that's unlikely. So you've had a big derating of the equity market, or a fairly substantial derating of the equity market. And this year, I expect the profits line to fall, which will lead to further falls in the equity market as the economy slows. So that's what's lying behind the forecast of another 15% down in equity markets globally. The valuation of the US stock market certainly is still fairly high. This is the cyclically adjusted price earnings ratio. So the kind of the P ratio smoothed over time, or today's price and earnings smoothed over a 10-year period. This is the Shiller measure. So this is a pretty dependable measure. So you can see it's come down from, what was that, almost 40 times in the bubble we saw recently, to below 30 times, but still historically fairly high. So you don't even have the valuation underpin as profits come down. So I think we're in a bear market rally. This is the S&P 500. We'll show some charts today. You can see it's peaked at about 4,700. It's troughed at about 3,600 recently, and it's bounced to about 4,000. This kind of downward sloping line, when a market kind of bounces off lower and lower levels as it recovers, it tends to keep going down. Unless it breaks up, which is possible, but I suspect it'll keep on going down. And the key point to remember, if I'm right on this, is that bear markets do take quite a long time to unfold. Okay. 2008 crisis, the crisis started in mid-2007. Didn't really get going properly till September 2008, and didn't trough until March 2009. So this is 2008 compared to where we are today. Today is the black line, and helpfully with an arrow there. And you can see 2000, 2008, 2009 was the final lurch downwards. So yeah, there's risk in the market, and these bear markets do take time, and you do get these bear market rallies within them. So I'm afraid I see more pain ahead. And you've got a couple of slides on the possibility of financial accidents. What do you tend to have when liquidity gets withdrawn from the system, which means interest rates are going up? Pockets of debt in the system are revealed, which previously have been hidden, because you suddenly got to start paying interest on your debt. Debt was free for 10 years. So these pockets of leverage, there's a couple of examples here. The BIS has warned that pension funds and other non-bank financial firms now have more than $80 trillion of hidden off-balance sheet dollar debt in the form of FX swaps. So these are repos in the market which don't have to be shown on a pension fund balance sheet or a non-bank balance sheet. So you can have all these transactions, which are derivative transactions, you don't have to show them anywhere, which is kind of fine as long as they're intact. But there's $80 trillion sitting there, which we don't really know what's happening. That's 80% of world GDP. Don't know, a risk factor. And the second and last one would be, before I move on, this is a very interesting article in the FT. So in private equity land, which in itself is going to go through some strains as interest costs go up, in private equity land, they're now selling to pension funds, not the direct private equity, but slivers of it and a bunch of other funds. And they're calling them collateralized fund obligations, which is scarily similar to collateralized debt obligations, which was the thing which brought down the system in the GFC in 2008, which was slivers of housing. Now it's slivers or little parts of private equity. So private equity, which itself is leveraged, is getting itself leveraged as these slivers get sold as collateralized fund obligations, CFOs. Hasn't been a mainstream thing yet. Again, it's a pocket of hidden exposure and leverage in the system. Okay, so I'm going to give you a slide break there. So that's the broad picture, maybe the most important picture. We've had 1 year of tough times. We're going to have another year of tough times in terms of the main asset classes being equities and bonds and real estate. And it's going to continue being a very volatile time. And I want to come on to the other asset classes and also what the shape of the world and equity market could be in this coming bear market and then potentially bull market after it. And it's going to be a very different shape to what we've had before. For the last decade, we've had large companies, US leadership, technology leadership, and industrial companies and commodity companies. Emerging markets, no one cares because the Fed's been pumping money into the system. It all goes into the US. It all goes into technology. Great, but that's going to shift. And what we saw, interestingly, in this bear market rally was the bear market rally was driven by different sectors of the market. It was those different sectors like commodities, like industrials, and the S&P 500, the US market, got left behind. And I've just shown you the returns since the start of this bear market rally, which started on October the 12th, 2022. And this shows you, this is from my friends at 13D, a research house, the bear market rally of the last 3-4 months. Look at the leaders, gold and silver, Hong Kong, silver, metals and mining, as semis in there as well, that have bounced, copper, industrial metals, emerging markets, gold, and then the S&P 500 is up 11%. But the best ones are up 20-30%. And the NASDAQ's only up 7%. Okay, and the dollar's down 10%. That tells me the US is done and emerging markets, non-US markets, commodity markets, industrials are going to do better. So it's a very important shift going forward within the market. So let's get into that a little bit. Why is this happening? Okay, we're going from US hegemony and US dominance to a multipolar world. We're going from low inflation to high inflation and low interest rates to high interest rates. That multipolar world is more volatile, which basically means the US doesn't lead the world anymore. We've got China and Iran and the Middle East and Saudi Arabia and India and the US. It's not going away, but it's a multipolar world of power, not just the US. which means more volatility. This is the Global Policy Uncertainty Index from our friends at BCA. This is a measure of geopolitical uncertainty, and it's pretty elevated because of this multipolar shift. And what's happening is the US can't call the shots anymore. And we've seen this in the Middle East. It withdrew finally from Afghanistan, which was its last bastion of influence. And China and Russia have all kind of filled the vacuum in the Middle East, either in Syria or China across Afghanistan and the other regions. China invested $10 billion in Afghanistan last year to rebuild it after the US had trashed it. So it's just shifting. This is a good chart, I think, to show it. The US, you may recall, banned Huawei, the Chinese technology and telecoms firm, which is a surveillance firm of the state, by the way, as I've discussed in the previous webinars. The US tried to ban it. They said, we don't want anyone having this across the world. Anyone. This is about 5 years ago. Who listened? Pretty much no one. In black are the countries which have actually banned Huawei. Okay, the US, obviously. The UK, yes, allies and all that. Australia, fine. I think Norway, is that Norway up there? And bits of Eastern Europe. They're the only ones who actually banned it. All the blue areas are planning to use it quite happily. Africa, Eurasia, Russia, Latin America, lots of Europe. So whatever, 10 years ago, the US said that, everyone would have banned it. It's changing. And we're seeing things like this. So in November last year, President Xi visited Saudi Arabia for what was arguably the most important geopolitical event of the year. One may have missed it, but this is President Xi meeting Mohammed bin Salman, MBS, in November. And it was a critical meeting. It was one of the first Xi had made outside of China since COVID. And they agreed a whole bunch of things. One is that China would be the biggest buyer of Saudi oil, and that would be quasi-guaranteed for the next 20, 30 years. And secondly, China would want to pay for that oil in renminbi, not dollars. So again, a critical shift. So Russian oil, for example, and post-Ukraine is being sold to India in rupees and UAE dirhams, not in dollars. China's now starting to buy Saudi oil and Middle Eastern oil in renminbi. That all is to be sold in dollars, and that's critical for the world financial system. So you're seeing a massive shift away from the US. The US is not part of this meeting. Biden went begging to MBS to increase oil production a year ago. That was an embarrassing meeting. He got told where to go. Xi got the state visit. And this is Chinese dominance. This is why he got the state visit. So the US trade with Saudi Arabia is now about $20 billion a year. China's close to $100 billion a year. Who's MBS going to be talking to? And China is leading the new global south, as we're now reading about. So this is the summit meeting, post that meeting with Xi and MBS in Saudi, where all the leaders of the global south, not a G7 country in sight, not America, not France, not Australia, not Britain. These were the Northern African countries, Southern African countries, Middle Eastern countries, Eurasian countries, including India. And that's the global south. So these trade routes, China, Iran, and Russia, Saudi, India, the Middle East, they are coalescing into a new power bloc. I've been talking about this for a little while. There's a critical geopolitical shift going on. And Russia, by the way, is very much part of it. This was December. This is Vladimir Putin on a video call with President Xi in December last year. And the Russian reinforcing the ties between Russia and China. And the global south countries, by the way, have not condemned the Ukraine war, for better or for worse, but they're siding with Russia. And the Russian economy, by the way, is doing just fine. Despite all the sanctions, they're simply shipping their oil at twice the price to China, to India, to Latin America, and sidestepping all the sanctions. So this is the Russian ruble, which initially collapsed against the dollar and is now higher than it was pre-invasion. It went from 80 to 150, back up to today about 65 cents. So Russia's doing fine, and the new global south is the new multipolar order. All of this means that US leadership in financial markets is kind of over. This is a chart which shows the US stock index over the last decade versus the ex-US stock index, i.e. the rest of the world in orange. So the US is in blue, the rest of the world is in orange. And you can see over the last decade, the rest of the world equity markets did basically nothing. The US equity market pretty much doubled. Well, it did double and came back a bit. That's extraordinary. We think that's going to switch. And you can see it in the same chart here. It shows you the top 50 companies in America versus the top 50 companies in Europe. This is for the last decade. And you can see the US is outperforming Europe for a decade. That means a downward sloping line. Okay, and Europe is now starting to recover against the US. So we're starting to see this shift into the rest of the world. It also means that things like commodities and gold will do better. Okay, I'm going to cover gold, commodities, and then get on to Bitcoin. Gold, let me give you a little break here for a second if I can get this right here. Okay, so the other thing about the global south is that they own all the commodity production. So Russia, oil, metals, and soft commodities are agriculture. China, rare earths. Middle East, obviously oil. Venezuela, oil. And that global south will control the commodity block, which is going to make commodities more expensive for the West. They're going to make it more expensive. That is undoubtedly going to happen. Plus, you've got geopolitical uncertainty, which means people are going to want to buy gold anyway. Plus, the US has weaponized the dollar. So it said, if your forex reserves, Russia, are in dollars, we're going to freeze them. So you can't have them anymore. That was the day 2 of the Ukraine war, which means all these central banks in the global south are going to buy gold instead of dollars for their forex reserves. So much more demand for gold. And that is already happening. Let me just open this slide. So I've got a new computer here and it's absolutely bamboozling me. Okay, this is central bank's share of gold reserves. Okay, so back in 1950, if you're a central bank in Asia, 70% of your forex reserves would be in gold, 70%. That got down to 10%. As people just bought dollars, they just bought treasuries. They're not going to do that anymore. China's already selling US treasuries. They're going to buy gold. So demand for gold from central banks is going up. And you saw that in the fourth quarter of last year. This shows you quarterly purchases of gold by central banks back to, that's the last decade, yes. So the fourth quarter last year was a record for the last 10 years. So central banks are buying gold, which means generally gold's going to do relatively well. And you can see it in this chart. Gold has started to recover. I've been talking about this for quite a few months, and gold has gone from it bottomed about 1625. It's today 1935. I suspect that'll continue. It's also a safe haven and a great thing when inflation's going up. So gold up 10% this year, I think. The other thing, in terms of commodities, this is a very different chart, so I'm going to give you a break for a second. So gold positive, commodities. The global south controls the commodity pie and will squeeze the West. So commodity prices tend to go up. The other thing about commodities is, as we go through the green revolution, we're building electric vehicles, we're building solar, we're building wind farms. Guess what all these things need? They need mined copper. They need zinc, they need platinum, they need rare earths. So a massive mining craze is going on. The amount of copper which goes into an electric vehicle is, I think, about 5 times what you need for a petrol car. 5 times the amount of copper for an electric vehicle. Massive amounts of copper and silver and aluminium, I think, into wind turbines. Rare earths, massive into solar power. And because we've been transitioning to a renewables world, there's been very little investment in these mines. So the world's going to get very short of copper. It's going to get very short of silver, where I'm also bullish. It's going to get very short of rare earths. China's got all the rare earths. The other commodities you can buy, or you can buy rare earths as well, actually, it can get more and more difficult. The other commodities you can buy, partly because of the shift to renewables, and you're going to need a lot of them. So the chart I wanted to show you was to reinforce, yes, this is electric vehicle sales, which are going up a lot. We know that. and that's going to require a lot more copper as well as other things. Another chart, the copper price, by the way, is the same price today as it was 15 years ago. I found that interesting. This is a chart which shows you how copper was kind of weak over the last year. And this is about a month out of date, and copper's broken out of that downtrend. I said I was going to show you some charts. Copper's broken out of its downtrend, and copper's looking very strong. So commodities is a really interesting place to be because it accords with an uncertain world and the world we're heading into. So commodities positive for the year, up 10%. Okay, let's finish with Bitcoin and South Africa. Quick reminder, Web 1, Web 2, Web 3. Okay, Web 1 was terrible. It was just terrible content, nothing happening really. Web 2 was we generated a huge amount of content. You and I, we just put our photos on there, all that kind of stuff. All our data got put on the web. That's Web 2.0. And all that data, all the photographs, all the stuff about us, all the stuff we shared, became owned by the FANG stocks, mostly Facebook, which controls 80% of the data feeds into the internet and Google. And they own our data, and we give them that data for free because we enjoy the service and we get it for free. The pact is that they get it for free because they can sell that data to advertisers who can sell advertising to us. So advertisers get access to our data, they can target advertising to us. I get different advertising to what you would get because I have different interests and different content. That was the Faustian pact with the monopoly of FANG providers for Web 2.0 who own our data. Okay, it's a kind of a strange pact, privacy issues, etc. What we're moving into is a world where the web is based on blockchain, and through smart contracts, I can retain ownership of my data and sell it to other people if I want to. Or I can sell my content to other people through smart contracts. It's a fundamentally different thing where the monopolistic dominant providers like Facebook get sidelined, and you and I, quote unquote, own this new universe, metaverse Web 3.0. I won't get too much into it. I've been through it in previous webinars. And that smart contract world where information becomes disaggregated again by individuals, the way it used to be when we owned our data and our content, and we could sell it to other people. Blockchain and smart contracts, in particular Ethereum, allow the provision of that decentralized data to be sold to other people. So the value chain is owned by the rightful owners. That's the key point about Web 3.0. And again, I've said this before, smart contracts, which are if-then contracts. If I sell you this computer, you will give me $2,000. If I sell you this car, then you will give me X amount of money. If-then contracts, those are smart contracts. They're all, well, 90% based on Ethereum. And Ethereum is the digital commodity which allows those smart contracts to work. They don't work without a digital currency backing it up. And at the moment, it's 90% Ethereum. So think of Ethereum like copper. We're just going to need more of it. And people ask me how to value it. We don't value copper based on a price or a value in terms of its intrinsic value. It's valued based on supply and demand. As demand for Ethereum goes up, then the price of Ethereum will go up. And we're starting to see it happen. Because, by the way, this Web 3.0 is being built, despite the tech bust, despite the crypto bust. And the strongest cryptos will survive and will come through to be the dominant players. So very interesting moves in Bitcoin and Ethereum in the last month. So that's the Web 3.0. And if you don't think this is going to happen, fine, that's good. Don't play it. But what will happen is that it'll happen really fast. Great example of this. I got 5 minutes to go. I'm going to accelerate a little bit. Great example of this. Okay, classic thing. Time taken to reach 1 million users. Netflix took 3.5 years to get to 1 million. Facebook, Spotify, Instagram, 2.5 months. Amazing. OpenAI, ChatGPT, which I think everyone in the world has now heard about, 5 days. So this is the AI bot, which can answer any question you want by whichever person you want. And it is now passing medical exams. It is now passing law exams. So you put your law exam paper into your chatbot, ChatGPT, and it answers the paper for you as if it was you of your age. It's extraordinary things. So this is AI becoming mainstream like in real time. As one example of the technologies which are exponentially growing, which again I've talked a lot about in the past. So this is happening really fast. So Web 3.0 is going to happen pretty quickly this year, and I think Ethereum is going to benefit. Oh, by the way, this is I enjoyed this. This is the OpenAI team. OpenAI was set up by Elon Musk, the great Elon Musk, I think 7 years ago. And so he owns a bit of it. Microsoft had just invested $10 billion into it for a 49% stake. So that's going to come through your Bing and Microsoft platforms. You're going to get OpenAI ChatGPT stuff. And this is the OpenAI team 7 years ago, first day. A bunch of guys and girls with a whiteboard. I find that wonderful. Look where we are today. Alrighty. I am going to go on to South Africa. Eskom load shedding. For those of you who are not as familiar with South Africa, some people view this from overseas. We're having some trouble, and you will have seen it in the Financial Times now. Corrupt, failing Eskom is a picture of South Africa in miniature. That's the kind of headlines we get offshore, which is why people have such a dim opinion of our country and economy, which is tragic. And it's tragic for all the people who suffer from, like all of us, like from these load shedding. Load sheddings are blackouts where you get no electricity. And they've been running up between 3 and 6 to 8 hours a day for the last couple of months. There is hope. This was published in January, just gone, this month. Energy action plan from the government. Take this with a pinch of salt, because I'm not sure they're going to deliver all this. I get all that. But there is a plan, and it is happening, and there's a lot of private sector involvement, and renewables are being built, and they are getting plugged in. And all those kind of solar panels on the top of the retailers, we've got solar panels on the roof of Old Mutual, which get plugged back into the grid. That is all helping. And we're going to stop exporting to Namibia. We're going to keep that electricity for ourselves. We're going to get imports from other Southern African countries. So there's about 9 gigawatts coming on in the first 6 to 9 months of this year. Currently, we're running at about 20 gigawatts. Capacity should be 40. So 9 gigawatts is quite a lot in the first half of this year. So we think, touch wood, we will avoid a total grid shutdown. I think we will. We will probably get more load shedding, but there is light at the end of the tunnel, literally. And if you take this whole plan, it's from the government, but mostly private sector coming in, there's about 40 gigawatts coming on, which is massive over the next 2 years. Now, a lot of coal is coming off, so that's fine, but there's a lot coming on. So that gives us a lot more hope that load shedding is maybe a thing of the past in due course for South Africa. And at the same time, if we're talking about South African equities and financial assets generally, we're very exposed to China. I've talked about China dominance. China's recovering, or will be recovering, quite sharply post-COVID now. And so Chinese growth in 2023 will be in sharp contrast to US recession. And for South Africa, China winning is a great thing because they buy more commodities, and we're a very commodity-dependent economy. So China grown by 5% in 2023. These are our forecasts at Old Mutual. And you can see here, this is a really interesting chart. This is the correlation of South Africa with China. On the x-axis, correlation of the equity market with Chinese growth. And on the y-axis, the correlation of the equity market with the Chinese equity market. And you can see it's one of the most correlated in the world. So China doing well is good for South Africa, good for our local assets. So we're thinking growth in South Africa this year, 2%, which actually for South Africa is not bad. We've averaged 1% for 5 years. Inflation coming down from 7 to 4, rates peaking, hopefully today, with the meeting of the BOE. And the fiscal side is in much better shape, by the way, partly because of commodity pricing. So that's very good news for our fiscus. And the rand, we actually expect to strengthen sharply in the near term. That's the focus for our economists. I would agree with that. The rand is pretty cheap. Currently trading at 17 to the dollar. I expect it to end the year at 15.5 to the dollar. It's up 10%. They even do better than that, because compared to the rest of the world, South Africa is going to look actually quite good. We've got elections in 2024. That's a risk. I understand the political risks, but Ramaphosa is in a stronger position post the last NEC convention than he was before. And the cabinet reshuffle in the beginning of February is going to be critical. We expect some movements in the energy space, which will be important for Eskom. And things are improving in South Africa. I know it doesn't feel like it, but by the end of this year, hopefully you'll feel a little bit more that way, and the rand should benefit from that. And final slide, the equity market is cheap. This shows you price to book. It's kind of a Z score thing. They normalize it. So Turkey's expensive. On the left is cheap. So South Africa is one of the cheapest equity markets in emerging markets. If I'm right and US goes down or loses its dominance and emerging markets and the rest of the world does better in terms of equity markets, South Africa will be a big beneficiary of that, and the Rand will be a beneficiary of that. Okay. I am going to sum up. I think I've kind of answered the questions on the way through, so I'm going to park the questions for today because there's a lot to run through. Okay, tough year for equities, down 15%, tough year for bonds, down 5%, particularly tough year for real estate, mind your eye on that. And it's all about commodities, gold and silver, and Bitcoin, up 30%. I should have put Ethereum on here. It's going to go up by more than that, is my view. Current price, I think 1,600 last I looked. So let's keep an eye on that one. And then relative terms, I think here in South Africa, we're going to do better than the rest of the world for the second year running, both from the point of view of our equity market and our bond market and our currency. So that's nice to convey. All these slides will be available, which I put out as a link, I think, to this on LinkedIn. So feel free to use them and peruse them as you wish. And let's hope for a good 2023 and a healthy one. If not, maybe a wealth creating one. At least one where we can get through and look forward to a better 2024, which may well come down the line. So mind your eye, look out for the volatility, and try and enjoy yourself. Thanks so much.